Today, we're diving into the pretty wild first half of 2025 for specialty chemicals company Matex International. Their latest financial report shows a company facing some serious headwinds, not just in the market, but right inside its own boardroom. So let's get into it.
Okay, let's cut right to the chase. Whenever you're looking at a company's performance, there's always one big number that kind of tells the whole story in a nutshell. For Matex, that number is not a pretty one.
And here it is. For the first 6 months of the year, Matex lost 2.3 million Singapore dollars. That's a significant figure, and it immediately tells you that things have been pretty tough for the business.
Now, a loss is one thing, right? But what's really telling here is the trend. This wasn't just a small dip into the red. We're talking about a loss that ballooned by over 50% compared to the same time last year. It jumped from 1.5 million to 2.3 million. When you see a jump like that, you have to ask,
what on earth happened? How did things get so much worse, so fast? Well, it turns out it was something of a perfect storm. It's a story of two very different problems hitting the company all at once.
So to really get what went wrong, we've got to unpack these numbers. It really boils down to two key stories on their income statement: the money coming in the door and the money flying out.
And wow, this slide just lays it all out, doesn't it? It's like they got squeezed from both sides. First, look at the left. Revenue just plummeted, down a massive 27%. The company blames things like inflation and economic uncertainty, stuff that made customers pull back and competition get really fierce. But then, on the other side, while sales were falling, their administrative costs, just the cost of keeping the lights on, shot up by 33%. And this wasn't from growing the business. It was mostly from a big $400,000 hit on foreign currency and fees from some very interesting corporate exercises.
And just to be super clear, when we say administrative expenses, we're talking about the fundamental costs of running a business. Think salaries, rent, and, this is key for our story, professional fees for things like lawyers and consultants. So when you see these costs spike, especially while revenue is tanking, it's a huge red flag for anyone watching the company.
But hold on, it's not all doom and gloom here. It's easy to look at that big loss and think the whole thing is a disaster. But if you dig a little deeper into the financials, you actually start to see a few bright spots, some signs of underlying strength.
So check this out. First, even though they sold less, they actually became more profitable on each item they did sell. Their gross profit margin improved to over 22%, which is great. Second, right in the middle of all this trouble, they managed to convince investors to give them more cash. And third, their short-term financial health, what we call their working capital position, actually got stronger. Pretty interesting, right? And that share placement back in January was absolutely crucial. Raising nearly $4.2 million gave the business a vital injection of cash, a much-needed buffer to help them ride out this tough period. It was a big boost to their bank account. Okay, now we get to the really juicy part. Remember those vague corporate exercises we mentioned that drove up costs? Well, now we get to find out what was really going on. The events that happened after the period these numbers cover give us all the context we need.
This timeline reads like a corporate thriller. It kicks off in early July when a major shareholder tries to oust two directors. Things got so heated that the company had to halt trading of its own stock. Then, by September, after a big shareholder showdown, the CEO and another executive were out. The whole saga finally ended just a few days later with a formal settlement agreement. What a whirlwind.
And that, right there, is the missing piece of the puzzle. This wasn't just office politics. It had a direct and very expensive impact on the company's finances. This intense boardroom battle is the real story behind that spike in costs that helped push Matex deeper into the red.
So, the dust seems to have settled in the boardroom, at least for now. But where does that leave Matex? What does the road ahead look like? The company's own report gives us some clues, and let's just say they're being pretty cautious.
Yeah, this is straight from the horse's mouth. The company is basically telling shareholders, hey, don't think this is over. They are stating very clearly that they expect to keep paying out more money related to that settlement and ongoing professional fees. The financial hangover from this whole mess is definitely going to continue.
So this all leaves us with a big, multi-million-dollar question, doesn't it? Matex is heading into the second half of the year with a new leadership team and fresh cash in the bank. That's the good news, but they're also facing a really tough market and are still paying the bills from that bitter internal fight. So the real challenge is, can the new team leverage the company's strengths to finally steer it back toward profitability? That's what everyone's going to be watching.